The Federal Reserve unveiling changes to its original plan on capital requirements for banks, scaling them back. Fed Vice Chair for Supervision Michael Barr saying the proposed changes would, quote, better balance the benefits and costs of capital in light of comments received. However, big banks we know came under pressure in today's trade as JPMorgan voices a cautious outlook for next year. And joining me now is David Konrad, Managing Director at KBW, Stifel Company. David, you are just the man to talk to today because your coverage universe, David, in focus, making a lot of headlines, different threads. I actually did want to start with JPMorgan. So JPMorgan's president, David, he's at a conference and he says, you know what, I think analysts might be just a bit too rosy here, I guess, in their projections of next year's net interest income, expenses. What did you make of those comments, David?
Yeah, well, we are actually below the street for 2025 in NII. But basically what's gone on here is, first of all, JP Morgan's one of the top financials globally and getting really stronger almost every day. But what happened this past year is their guidance kept being raised because they're asset sensitive. The forward curve didn't materialize and the Fed really didn't cut rates yet, obviously, this year. So their estimates this year beat expectations. But now as we're looking, going forward, we're expecting 3 to 4 cuts, perhaps in this fourth quarter, and then cuts next year as well. So some of the asset sensitive names will feel some pressure as we go into next year on their NII.
And let me get your take on another name, David. So I know JP Morgan, I believe you're on the sidelines, but another name you cover also made news. Goldman, that's a name you like. Mm-hmm. Goldman's chief also making comments saying, listen, maybe trading revenue could fall 10% in Q3. Your reaction to those comments, David?
Yeah, there's a couple things there. That was a little bit disappointing. Obviously, trading's a little more of a volatile number, and they were coming off of a really difficult comp in the prior year. But there's a lot of volatility in August, and it's seasonally, also a slow volume period as well. And so, we think that's a little bit not necessarily a trend line, but a tough quarter there. The other thing they announced was a $400 million charge on contra revenue as they prepare to sell the GM credit card portfolio. Although that was a negative headline, we actually think that's good news for the stock.
Broader question, David. This morning, new proposed capital requirements. When you saw those numbers, was that basically in line with your expectations, David? Were you thinking it was going to be lower? What'd you make of it?
No, I think they were largely in line. I mean, it took away a negative scenario, but reducing the capital requirements by 50% was kind of in the market a little bit. And that's really basically where it came into. So, I think, Vice Chairman Barr said that, he expects capital to go up around 9% for the GSIBs. We're currently 11% in our model. And that feels about right because, the bank's calculation has historically been a little bit higher than the Fed's calculation. So largely in line. And then the other move there was the RWA inflation won't apply to the category 4 banks. So that's the banks between 100 and 250 million. That's really a non-event. The RWA inflation wasn't that high for them anyway. The big issue for them is the mark-to-market of the bonds, which still does stay in the capital. So kind of a non-event for that.
And does it mean, David, would you expect banks now accept that proposal, think this is as good as it's going to get, or would you expect them to fight?
Oh, there'll be a little bit of a fight, right? But I think this is broadly, what they were looking for. I mean, I think what happened is, the Fed typically gold plates the international standards, and then they took it a step further with this proposal. So what ended up happening is you had the U.S. banks holding a lot more capital than the global banks. And so I think this largely adjusts that.
David, a quick question here. Last one. I look through your coverage universe. I only see one lonely underperform, and that is PNC. How come?
Well, it's one of the more expensive names out there. It is a quality name. Their kind of outlook is for a very strong 2025 NII, a record number, but we think that's largely embedded in the numbers. And so it's trading roughly at a 2-turn premium to the group with relatively inline returns. So we just think as numbers come in, as its peers recover on capital, we think there'll just be a mean reversion of those P's closer to the peer levels.
David, appreciate you coming on the show, and thank you for those stock picks.
You bet. Thank you.
Well, Fed Vice Chair for Supervision Michael Barr is speaking right now, previewing a proposed package of revised rules for the country's biggest banks. Here with the latest, we've got our very own Jennifer Schonberger. Jennifer, great to see you. What do we know so far? What are we hearing?
Good morning, Brad. Great to see you as well. The Federal Reserve unveiling its planning sweeping changes to massively scale back a proposal to raise capital requirements for the nation's largest banks after politicians and banks had pushed back on an initial plan, warning that it could restrict lending and hurt the economy. The new proposal, known as Basel III, would increase capital levels for big banks like JPMorgan and Bank of America by 9%. That's down from half of the original plan from more than a year ago that set the capital increase at 20%. Now, banks with assets of between 100 and 250 billion, which were initially subject to the stricter standards of the largest banks, would no longer be subject, other than the requirement to recognize unrealized gains and losses of their securities and regulatory capital. This is a major reversal following a string of regional bank failures last year, led by Silicon Valley Bank. Fed Vice Chair of Supervision Michael Barr laying out his vision this morning in a major speech here in Washington at the Brookings Institution, saying, quote, capital has costs too. As compared to debt, capital is a more expensive source of funding to the bank. Thus, higher capital requirements can raise the cost of funding to a bank, and the bank can pass higher costs to households, businesses, and clients engaged in a range of financial activities. This is certainly an about face for Barr after even colleagues on the Federal Reserve Board, including Fed Governor Mickey Bowman, had voiced concern about this in addition to the banks. Barr says that today's proposal reflects public comment and that it improves the tiering of the proposal and better reflects risks. Now, these changes were made in concert with the FDIC and the Office of the Comptroller of the Currency. All three of these institutions would need to vote in concert to finalize this new proposed rule. Barr says, however, this is just an interim step at this point and that the Fed is taking comment on this new proposal. Guys,
all right,
back to you.
Jennifer, thanks so much for laying that all out. And we would be remiss not